A project raises $50 million from top venture capital firms, Andreessen Horowitz. Sequoia, Paradigm. The biggest names in Silicon Valley are backing it. It launches on Coinbase. The price pumps 300% on day one. Everyone on Twitter says this is the one. You buy. 3 months later, the price is down 85%. You're holding bags worth a fraction of what you paid. The VCs that everyone was excited about, they're up 2,000% and already sold. This isn't bad luck. This isn't a market downturn. This is the structure of how crypto venture capital works. Designed from the first dollar to extract maximum value from retail investors while giving the appearance of institutional validation. This video breaks down exactly how crypto VCs operate, why their involvement almost always hurts retail investors, and what to look for to protect yourself from being their exit liquidity. Venture capital firms raise money from institutional investors, pension funds, university endowments, family offices. They invest that capital into early-stage projects in exchange for token allocations at extremely low prices. A VC might invest $5 million into a project when tokens are valued at 1 cent each. They receive 500 million tokens. The project launches publicly at 10 cents. The VC's allocation is now worth $50 million on paper, a 10 times return before public trading even begins. This is the standard structure. The VC's cost basis is so far below the public launch price that almost any outcome except complete failure is profitable for them. For retail buying at launch price, the math is completely different. Projects and their PR teams always highlight vesting schedules as investor protection. VC tokens are locked for 12 months with a 24-month linear vesting period. This sounds reassuring. Here's the reality. If VCs paid 1 cent per token and the token launches at 10 cents, after 12 months the price only needs to still be above 1 cent for them to profit from every single token they unlock. The token could drop 90% from its launch price, and VCs are still breaking even. Retail who bought at launch is down 90%. VCs are at break-even or profit. The vesting schedule doesn't protect retail investors. It just determines the timeline over which VCs sell into retail buying pressure. Every unlock event is a scheduled selling opportunity for people whose cost basis is a fraction of the current price. VCs don't invest blind. Before writing a check, they receive everything: detailed tokenomics, full team background, technology audit, business model projections, legal structure analysis, advisory relationships. They have weeks or months of due diligence access to information retail investors never see. By the time a project launches publicly, VCs have already determined their investment thesis, negotiated their terms, and secured their position. Retail investors get a white paper, a slick website, and a 10-minute YouTube video from a paid influencer. The information available to make the investment decision is categorically different. VCs are making informed decisions. Retail is making marketing influence decisions. This isn't a level playing field. It was never designed to be. Look at the tokenomics of any major VC-backed crypto project and you'll find the same pattern. Team and advisors, 15% to 20%. VC investors, 20% to 30%. Community and ecosystem, 30% to 40%. Public sale, 5% to 15%. Do the math. Between 35% and 50% of all tokens go to insiders at prices retail investors will never access. The public sale represents a small fraction of total supply at the highest prices available at launch. When the project launches, 35% to 50% of supply is waiting to be sold by people with dramatically lower cost bases. You're buying into a structure where half the cap table is positioned to sell to you. That's not an investment opportunity. That's a distribution mechanism. Launch day for a major VC-backed project follows a predictable script. Weeks of marketing build anticipation. Influencers who received paid promotions or token allocations generate buzz. The project lists on major exchanges simultaneously. Initial supply is artificially constrained. Only the public sale percentage is available. Limited supply plus high demand equals explosive price action on day one. Retail FOMO drives the price to multiples of the listing price. This peak serves a specific purpose. It establishes a high price point that makes future VC and team token unlocks maximally profitable. The launch day pump is not organic market discovery. It's the culmination of a coordinated marketing campaign designed to maximize the value of insider allocations before they unlock. When a 16Z invests in a crypto project, it generates immediate credibility. Their involvement signals to retail that smart money has validated this opportunity. But consider what a 16Z's involvement actually means for your investment. They invested at prices 10 times to 100 times below launch. Their return is already baked in before you buy. They have board seats and information rights you don't have. They're actively working to maximize their token value, which means marketing, exchange listings, and narrative management designed to create selling opportunities for them. Their investment in the project is not alignment with your interests. It's confirmation that insiders see enough potential for them to extract value. Your job in this structure is to provide the liquidity they extract from. Aptos, APT, raised $350 million from a 16Z, Multicoin, and others, listed at $8 in October 2022. Hit $20 in January 2023. As VC and team vesting unlocks happened through 2023 and 2024, consistent selling pressure kept price suppressed despite strong marketing. Retail who bought at launch remains underwater from peak prices. VCs who invested pre-launch are deeply in profit at almost any price. ICP, Internet Computer, raised hundreds of millions from Andreessen Horowitz and others, listed at $700 in May 2021. Now trades around $8, a 98% decline from launch. VC investors who participated at seed rounds paid fractions of the listing price. The people who lost 98% are retail investors. Worldcoin, WLD, backed by Sam Altman and major VCs, launched publicly at inflated prices. Team and investor allocations represent the majority of supply. Price has consistently declined from launch highs as unlock events create persistent selling pressure. The pattern across dozens of major VC-backed projects is identical. Retail buys near the top. Insiders sell on the way down. Most people don't know that major crypto projects hire market makers for their token launch. Market makers are paid in tokens or fees to provide liquidity and manage price action. They have access to significant token allocations and the ability to create artificial trading volume. During the launch period, market makers can suppress volatility to create the impression of stable price discovery, while insiders are distributing tokens. Once market-making agreements expire or token allocations from market makers are sold, natural price discovery resumes and prices often decline significantly. You're not seeing organic market price action at launch. You're seeing managed price action designed to facilitate insider distribution. Getting listed on Coinbase, Binance, or Kraken costs projects significant money. Estimates range from $1 million to $10 million or more for top-tier exchange listings. These fees are paid in tokens in many cases. That means the exchange receives a token allocation at pre-listing prices. The exchange now has an incentive to list the token and generate trading volume that allows them to sell their allocation profitably. They market the listing to their user base. Users buy. Trading volume increases. The exchange sells their token allocation into that volume. The listing that appears to be a validation of the project's quality is partly a financial arrangement that creates another insider with tokens to distribute. Between VCs and retail investors sits the influencer layer. Crypto YouTubers, Twitter personalities, podcast hosts, many of them receive token allocations, paid promotions, or advisory roles in projects they cover. When an influencer with 500,000 followers makes a video about a new VC-backed project, their audience interprets it as independent analysis. In many cases, it's a paid distribution channel for the project's marketing. Disclosure requirements exist, but enforcement is limited and inconsistent. The influencer makes their video, their audience buys. The influencer and the project both benefit from the increased buying pressure. The audience member who bought based on what they believed was independent analysis is providing exit liquidity for multiple layers of insiders simultaneously. Counterintuitively, heavy VC backing in a crypto project should trigger caution, not excitement. Before buying any token, check these things. What percentage of total supply do VCs and team hold? If it's above 40% combined, proceed with extreme caution. What are the exact vesting unlock dates? Map, when large amounts of insider tokens become sellable. What price did VCs pay versus current price? The larger the gap, the more selling pressure exists above your purchase price. Are multiple top-tier VCs involved? Paradoxically, more prestigious backing often means more sophisticated distribution infrastructure designed to extract value from retail. The presence of Sequoia or a 16Z should prompt more research, not less skepticism. Not every crypto project is a VC extraction scheme. Some patterns correlate with better retail outcomes. Fair launches where founders and VCs buy at the same price as public investors. Projects with minimal or no VC backing where team tokens are small and vested over long periods. Proof of work coins that can't be pre-mined and distributed to insiders before launch. Projects where token distribution is genuinely decentralized from the beginning. Bitcoin is the ultimate example. No VC round, no pre-mine for founders, no insider allocation. Satoshi mined Bitcoin publicly alongside everyone else from day one. The coins Satoshi holds are publicly visible and have never moved. This structure is radically different from modern VC-backed projects and explains much of Bitcoin's credibility and longevity. The SEC has argued that many VC-backed token sales constitute unregistered securities offerings. When a project raises money from VCs in exchange for tokens expected to appreciate, that looks like an investment contract under the Howey test. Several major projects have faced SEC enforcement. The challenge for retail investors is that regulatory action comes after the distribution has already happened. By the time the SEC charges a project, VCs have often already sold their allocations. Retail holders are left with tokens that are now also under regulatory cloud, further suppressing prices. Regulation that theoretically protects retail often arrives too late to prevent the harm. If you're going to invest in VC-backed crypto projects despite everything in this video, here's the minimum research framework. Find the full tokenomics breakdown, not the marketing summary. Calculate the VC cost basis versus current price. Map all unlock events on a calendar. Research every named VC investor and their track record in crypto specifically. Find the market-making arrangements if disclosed. Check if influencers covering the project have disclosed material relationships. Calculate what percentage of supply will be unlocked and potentially for sale in the first 12 months of your holding period. If this research takes less than 10 hours, you haven't done enough. The projects worth buying will survive the scrutiny. The ones that can't be researched thoroughly enough to answer these questions probably shouldn't be bought at all. Bitcoin requires none of this research, no vesting schedules to track, no VC unlock events to fear, no insider allocations sitting above your purchase price, no market maker arrangements artificially managing price, no influencer disclosures to decode, no tokenomics designed to extract value from late buyers. Just a fixed supply monetary asset with 15 years of price history and global adoption. The boring choice has beaten the exciting VC-backed opportunities consistently. The people who ignored the hype around ICP, Aptos, Worldcoin, and dozens of others and simply held Bitcoin came out significantly ahead. That outcome isn't surprising when you understand the structure of how VC-backed crypto projects are designed to work. Venture capital involvement in crypto is not a signal of quality. It's a signal of sophisticated distribution infrastructure. The VC's interest is maximizing their return on a cost basis retail investors will never access. Their marketing creates excitement that enables that distribution. Their institutional credibility provides cover for retail FOMO. Their vesting schedules create the illusion of alignment that doesn't actually exist. When the big names invest in a crypto project and everyone on Twitter says this is the one, what they're really saying is that sophisticated money has decided this project is good enough to sell to retail at a markup. You are the retail. You are the exit. Understanding this doesn't mean never buying anything except Bitcoin. It means going in with accurate expectations about what VC backing actually represents and doing the research to understand the tokenomic structure you're investing into. Comment the name of the VC-backed project that cost you the most money. No shame. Most people in crypto have at least one. Next video, I'm breaking down altcoin research properly the framework for finding legitimate projects before the VC distribution machine gets to them, and the specific metrics that separate actual opportunities from sophisticated exit liquidity schemes. Subscribe to Unbanked. The old money had a head start. You have the internet.